Hello friends, welcome to the higher module on institutional management for entrepreneurship. This is the last unit, unit number 8 on management of business enterprises. This is the third video in this unit and it is on financial management. The contents of my presentation: first, what is financial management, then what is working capital management, then different financial ratios and their significance, and then the tips to improve the financial management. So, the first is what is financial management. Well, the financial management refers to the strategic planning, organizing, directing and controlling of financial undertakings in an organization. The primary objective of the financial management process is to optimize the financial and economic benefits of an investment. Financial management controls the financial activities of an organization such as procurement of funds, utilization of funds, accounting, payments, risk assessment and every other thing related to the money. It takes financial decisions under three main categories, namely investment decisions, financing decisions and the dividend decisions. So, you can see on this slide, so mainly three areas: financing, investment and the dividend decisions. Let us discuss them one by one. So, first is the investment decisions. The managers have to decide how much amount of investment is available out of the existing finances. Investments decisions are of two types. Number one, the long term investment decisions or the capital budgeting. It means committing the funds for a longer period of time like fixed assets. These decisions determine the performance of a business. And secondly, the short term investment decisions or working capital management. It means committing funds for a short period of time like the current assets. These involve decisions pertaining to investment of funds in inventory, cash, bank deposits and other short term investments. They directly affect the liquidity and the performance of the business. The second category was the financing decisions. Managers also make decisions pertaining to raising the finance from long term sources called as the capital structure and the short term sources called the working capital. They are of two types. First, the financial planning decisions. These relate to estimating the sources and the application of the funds. And secondly, the capital structure decisions. These involve identifying the sources of funds. They also involve decisions with respect to choosing the external sources like issuing shares, bonds, borrowing from the banks or internal sources like the retained earnings for raising the funds. The third type was the dividend decisions. These involve decisions related to the portion of the profits that will be distributed as a dividend. The shareholders always demand a higher dividend, while the management would want to retain the profits for business needs. Hence, the manager has to take an appropriate decision. Okay. The second part of this presentation is the working capital management. You see, every business needs funds for two purposes, that is for its establishment and to carry out the day to day operations. Funds required for the establishment of a business get invested in purchase of fixed assets in the form of plant, machinery, land, building and furniture, etc. Requirement of funds for creating these facilities is termed as the fixed capital. On the other hand, funds are required in a business to carry out the day to day operations. Business needs money to purchase the raw materials, to maintain the work in progress, to maintain the required level of stocks of finished goods, to meet day-to-day running expenses like payment of wages and salaries, office expenses, etc., and to sustain the business activities during the period for which the goods have been sold on credit. This means the money will flow into the business on completion of the process cycle, which involves these steps. Number 1, the purchase of raw material, then conversion of raw material into the work in progress, then conversion of work in progress into the finished goods, then conversion of finished goods into the sales on credit, and lastly the conversion of credit sales back into the cash. This is known as the operating cycle. So, you can see this operating cycle on your screen. So, we have the cash, or we have the money in the form of a cash. So, from the cash we purchase the raw material, from the raw material this is work in progress, and then you have finished goods, and then you sell them on credit, and again you get back the money in the form of a cash. So, this is the operating cycle, and the money which we need to run the cycle is called as the working capital. In simple words, the working capital refers to that part of the firm's capital which is required for financing the short term or the current assets. Funds thus invested in current assets keep revolving fast and are being constantly converted into cash, and this cash flows out again in exchange for other current assets. Hence, it is also known as the revolving or the circulating capital or the short term capital. Next is the factors which affect the quantum of working capital. The quantum of working capital will basically depend upon two factors. First is the level of activity. That means, in the case of a manufacturing business, it takes a lot of time in converting the raw material into finished goods. Therefore, the capital remains invested for a long time in raw materials, in semi-finished goods, and the stocking of the finished goods. Consequently, more working capital is required. On the contrary, in case of trading business, the goods are sold immediately after purchasing. Therefore, very little working capital is required. There is also a direct link between the working capital and the scale of operations. More working capital is required in case of big organizations, while less working capital is required in the case of small organizations. So, the second factor is the duration of operating cycle. This is a very important in the working out the quantum of working capital. Shorter the operating cycle or the process cycle, lesser will be the requirement of the working capital, and longer the duration of the operating cycle, more will be the requirement of the working capital. Now, let us discuss the sources of financing of working capital. So, there can be many sources, like number 1 is your own funds or the equity. The promoter's contribution is also termed as own funds or margin money or the equity. The amount of own funds is partly utilized towards acquisition of fixed assets and partly as a margin towards the working capital loan. Secondly, the sundry creditors, the credit available against the purchase of materials is used to meet the working capital needs. Next is advances from the customers. The money received as advance payments can be utilized to partly finance the working capital requirement. You can also take a working capital loan from the commercial banks. Commercial banks are the most popular sources of financing the working capital requirements of small scale units. Normally, 70 to 80% of the working capital requirement of small units is financed by the banks. Okay, then we go to the next part of the presentation, which is on the financial ratios and their significance. You see, a banker applies different methods or techniques to appraise a loan application. One such tool is the ratio analysis. It helps the banker in arriving at a conclusion with respect to the solvency of a firm or company and in forecasting the trends analysis. There are different types of financial ratios. They can be categorized into many categories and subcategories. Like first is the stability ratios, and this we have the proprietary ratio, the total liabilities to net worth ratio, also called as debt equity ratio. The second is the liquidity or the credit ratios, and this we have the current ratio, quick ratio. The next category is the turnover ratios, and this we have the total assets turnover ratio, fixed assets turnover ratio, net sales to net worth plus deferred liabilities ratio, inventory turnover ratio, sundry debtors to the average debtors ratio. The next classification is the profitability ratios, and this we have the gross profit to the net sales ratio, net profit to the sales ratio, return on capital employed ratio, net profit to total asset ratio. Then the next is the appropriation ratios, and this we have the depreciation to the gross block ratio, then the tax provisions to pre-tax profit ratio. The next category is the capitalization ratios, and this we have the capital gearing ratio, the deferred liability capital ratio, and the equity capital ratio. Then we have the debt service coverage ratio. We will discuss only 3 main ratios over here. For more details, you can refer to the e-contents. So, first is the current ratio. This is one of the first tests used for analyzing the solvency of a company is the comparison of its current assets with the current liabilities. There is no ideal current ratio in business. However, a current ratio of about 2:1 may be considered near ideal. A higher current ratio may indicate that the company is not borrowing by way of long term loans to the full extent. Next is the debt equity ratio. This ratio represents the relationship of the creditor's equity to the owner's equity in the assets. Although a debt equity ratio of 2:1 may be considered near ideal, it cannot be considered as a yardstick. The debt equity ratio gives a measure of the owner's stake in running of the company vis-a-vis the creditors. The next is the profits to the net worth ratio. The profit to the net worth ratio indicates the ratio of the profit returned on the owner's capital funds. Based on this ratio, the board of directors of a company decides the rate of dividend to be paid to the shareholders or the ratio of bonus shares to be declared. Now, lastly, let us discuss the different tips to improve the financial management. First is you must make a clear business plan or a project report. Then regularly monitor your financial position, ensure customers' payments on time, know your day-to-day costs, keep accounting records updated on daily basis, pay your taxes on time, become more efficient and control the overheads, efficiently control the stocks, get the right funding and tackle the problems whenever they arise. So, that is all in this video. Thank you so much.